we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines at this hour. Markets are off to the day's low, but trade weak for the sixth straight day. The Nifty trades around the 11,400 mark, while the PSU Banking Index is the only index trading in the positive territory. Zee Entertainment has recovered from the day's low after the management says that the talks for its stake sale are at an advanced stage. Vedanta is the top loser on Nifty after its fourth quarter earnings. Aluminium and zinc business aided the quarterly earnings. And Titan is among the few gainers on the Nifty ahead of its fourth quarter numbers today. Good afternoon, Neeraj. Well, the selling pressure is only intensifying. I think for the week now, Nifty's lost about 250 points.
Yeah, and heavyweights are crumbling under pressure. You don't normally, you can understand a Z falling or a DHFL falling, etc., etc. But for Reliance to do what it is doing speaks volumes about the kind of stress that we are in. Again, just about 0.5%. We haven't come lower than the lowest level that we've done today. So if you look at the intraday, this is about 0.6, 0.7 odd percent is about the level that we've been trading at for most part of the trading day today, maybe slightly lower at a point of time, but this is about the levels that we've traded lower in the session today. The point is, would today's session be marked by day of higher volumes? Tomorrow will be. The question is, will today we'll have cash market volumes being higher than what's happened the last couple of days, and will it be accompanied by FI selling? That's the key thing that we need to ask. If we can just pull up the volumes first, the cash market volumes at about 22,000 crores. Remember, par for the course, 30, usually now used to getting about 30 to 33 as well. We might well stand a chance of having that on a day when we are losing out. Quite unlike yesterday, wherein we lost a significant portion in the second half, today we've been lower for a better part of the trading day today, and therefore this might not be auguring well. However, let's get the heat map up on the screen, and you will see that there are some heavyweights which are correcting, and which is the concern point. Z has been down today almost from the start of the trading day, and it stayed lower. So no surprise that in fact it was down about 8% at a point of time, and is now down about 5%. But look here, this is the problem area. Reliance Industries down about 3.5%. We've seen private banks and private financials like HDFC, Bajaj Finance going down, so that's the other problem. SBI is down about 1% as well, and we don't have an equal and opposite reaction from heavyweights on the upside. The heaviest stock on the top gainers list is TCS, which is just about 0.28%. So the biggies are not punching their weight on the upside. In fact, stocks like Reliance are falling quite severely, and that is the one problem. Before we just start talking about the mid caps, I just want to mark if we can get the GIP3 for Reliance Industries. That shows what the big boy has been up to in the last 3 or 4 sessions on a 3-day chart of Reliance Industries, whichever we can, and you will see the pressure that is there on the large cap name. This is the 3-day chart of Reliance Industries, and as you can see, from levels of close to 1400 or northwards of 1400, we are now at 1311. That's quite a steep cut, about 7% lost in Reliance Industries in the last 3 days alone. Large caps under pressure. Mid caps not too different either.
Seeing a reflection of what the large caps are doing, even in the mid-cap space, Neeraj. And individual stocks are getting beaten down about 5.5% seems to become the norm in the last 2 or 3 trading sessions because of the, the skid of the markets that we've seen globally, not just in India. But taking a look at individual counters, then in the broader market space, we'll start off with a counter like a Dish TV. While Neeraj has already highlighted what Z has been doing, but the SL Group stocks as a whole require some amount of focus. So Dish TV itself was down much more more than that in today's session, has recovered a bit. So now it's down about 2% in intraday trade. Some amount of clarifications coming in from the management on other media channels suggesting that there were no pledges that were revoked. They are still looking at two binding agreements, two binding term sheets they're looking at, but they couldn't divulge much in terms of what valuations and the rest of the other details. The results will come out on the 27th of May. That is what the management highlighted. Brigade Enterprises, it's down 1% right now from being up about 3% had a stellar quarter, 75% increment on the top line. We'll get the management to talk about this in greater detail as to what they're doing right. Vodafone Idea, so your rights issue hits, the shares hit the market today, and you're probably seeing some amount of selling coming in there. Remember, rights happened at a price of about 12 odd rupees. That is a very lucrative price. So looking at some profit taking at the current market levels. Jet Airways, Edelweiss are some of the stocks which are doing well. You had a Rain Industries up until half an hour ago, which was doing about 2.5% to 3%. It's come down in the red right now. Stocks losing out include the likes of Indiabulls Real Estate, Oberoi Realty, Soba Developer. So as a pack, real estate is looking weak, and you're seeing heavy cuts of about in excess of 4.5% to 5% apiece. So these are the key laggards there. And some stocks on the back of heavy volumes that we're seeing. CG Power, we know that Sunil Mittal is increasing his stake, and we've got the stock up about 9%, 3.84 crore shares have been traded there. Inox Leisure reports numbers on 13th May. Watch out for that one. Strong content pipeline for the stock, and it's been doing well, and today as well holding steady ground. And Finolex Cables, which has moved up and with volumes much higher than its last 20 days average. So these are the stocks keeping an eye out on. But what's happening in the derivative space and what's been moving there? Navneet is joining us to tell us that. Navneet.
Thanks for that, Davina. Well, yesterday we didn't see any build-up on the short side, at least for Nifty futures. It was the bank Nifty where open interest was higher. Let's check what's happening in today's session. No, not major build-up once again, at least for Nifty futures, up only 3.5%, and the premium is maintained. The bank Nifty futures where OI was up 6% yesterday, nothing much has happened at least so far, but the index is down 0.5% into it. And interestingly, markets have been lower, at least for the last two sessions yesterday and today. India Wix has not done too much. It's just about trading flattish. However, it has been trading at elevated levels around that, still above the mark of 26. So what's the next level that the street should be watching out on the downside? Now remember, 11,550 was a sacrosanct level which everybody was talking. We breached that yesterday. Watch out for 50 DMA on Nifty, which is somewhere about 11,390, and for Bank Nifty, 29,000 on the downside. To be specific, 29,069 is the 50 DMA for Bank Nifty. In terms of active strikes on Nifty side, it's 11,500 call and the 11,400 put. With the markets falling, the base is moving lower. In terms of maximum OI concentration on the call side, now it has moved to 11,500. Remember, at the start of the series, it was at 11,800. A lot of writing has been seen at 11,450 strike in today's session. That's added almost 12 lakh shares, and even the 11,500 call strike has seen addition of nearly 33.5 lakh shares. And on the put side, 11,400 put remains active for the day. Three stocks I want to talk about is Kajaria Ceramics, which has snapped the 3-day fall. The stock was weak in the past few sessions. Open interest build-up of 22% seen. You're seeing some bit of long positions coming back into this counter. It comes out with its numbers on Friday. That's May 10th, so watch out for this. Voltas is the other one, which is trading weak today. The counter is down 2.5%. And interestingly, on the futures side, there's a lot of build-up, 25% higher for open interest. The numbers come out tomorrow for this one. Watch out for Voltas. It's going in on a weak note, entering into the earnings season. Z Entertainment is the other one. The stock's fallen almost 20% in last 5 sessions. The fresh shorting continues here. No matter, there is some sort of clarification which has come from the management, but that's not assuaged the concerns. The counter still continues to trade with cuts of nearly 5%.
Well, interesting trends. Let's begin the show with the global voice, because frankly, aside of what's happening locally, the globe is in a bit of turmoil as well after Sunday's tweets. Daniel Morris of BNP Paribas Asset Management joins us right now from London. Daniel, good having you. Thanks much for joining in. Good morning to you out there.
Sure.
Would you reckon that assets and equity assets in particular could remain under pressure after not just Donald Trump's tweet, but Lighthizer comments as well about the rates, the tariffs going up on Friday? Will that have a prolonged impact on risk assets?
Well, I think it will certainly depend on how quickly this was resolved, but the reaction of the markets over the last couple of days certainly highlights the vulnerability in equity markets to disappointment. I mean, essentially, we've already priced in the agreement between the U.S. and China, so anything that upsets that assumption clearly reflected quite quickly in the markets. A lot of uncertainty, as much as anything else, around the actual details of the agreement, if and when it comes. So yes, I think we're likely to see continued volatility until this is all done and dusted. And at this point, we're not certain exactly when that's going to be.
Daniel, the nature of the rally, at least in the US markets, was that it was a very narrow move. At least most people seem to suggest that for the better part of 2018. What we've started to see now, when the corrections are happening, that they're more broader in nature, especially the one yesterday, which was very similar to what happened on Christmas Eve, wherein almost 90% of the S&P 500 constituents came off. Would you reckon that this nervousness, I mean, I take on board your point that this depends on when it gets resolved. Until we get any kind of news flow about the resolution, would you believe that equities across in these impacted countries would see a bit of a pullback? And how severe could the pullback be? Would it be swift in nature, or would it be a slow, gradual one?
Well, you've got to think about what are the risks to the market at this point besides a breakdown in the negotiations between the U.S. and China. Of course, Trump could turn just as quickly to threats of tariffs against Europe, and I think it's clear what that would do, particularly to European equities and German equities. I think on the other hand, though, we need to recognize what's supporting the market, which I think two factors right now are very important and very positive. One, of course, we had surprisingly strong U.S. growth in the first quarter, so that suggests all the talk that we had at the end of last year about the risk of a recession in the U.S. was quite overdone. So underlying fundamental growth still very solid in America. And we also need to recognize that the earnings results for this quarter are also very good. At one point, we had expected an earnings recession, if you will. People were forecasting negative year-on-year earnings growth. It's coming in around 5%, which is not spectacular, but compared to the negative expectations before, quite good. So the point here is, yes, we have the risk primarily around trade, but the Fed is still very supportive. It's not going to be raising rates. Economic growth is good. Inflation is quiescent, and earnings growth is coming in quite strong.
We also closely going to be watching out for more data that's comes out from China, the year-on-year export numbers for the month of April, as well as the import numbers, balance of trade figures. Considering that the last GDP print that we got of 6.4% from China was a relatively strong one, if these trade hurdles continue, and the conversations keep getting delayed or getting pushed back, and if actually the tariffs come about, which they most likely will on Friday, does that number get threatened, and in a way the repercussions for most of the other emerging markets as well?
Well, you're right to focus on the outlook for China, because that's going to be crucial, certainly for that market, but also for the rest of EM and frankly also for Europe. To be honest, I think the data out of China, broadly speaking, has been positive. It does suggest the economy bottomed probably around January, and the stimulus measures the government put in place at the end of last year and into this year probably are going to be enough. However, if trade tensions re-escalate and you see certainly an increase in tariffs put on Chinese exports, the government is likely to have to do more to offset that drag on the economy. So I think it's very much touch and go. The economy looks good. It looks to be recovering. But if you do see a deterioration in the relationship with the U.S., they'll have to do more, particularly to support domestic demand.
All right. The other point being is, while we're taking a look at it from an emerging market standpoint, your foreign money has been pretty liberal in terms of the month of April and the kind of funds that came into the country. I'm talking about India, but emerging market allocation itself has gone up. There has been money that had flowed in back into China. Keeping in mind that there is increased amount of volatility that is expected, do you see that getting a bit of a bigger risk for foreign money and a pull out of that moving back into the U.S. economy?
Well, I think it's been notable really how poorly emerging market equities have done so far this year, with the clear exception of China, which is really just a reaction to the very poor performance last year. So China's rebounded very strongly, but net not necessarily up so much. The rest of emerging markets has lagged. I think at least part of that has to do with the dollar, which has been stronger than we expected against emerging markets. Secondarily, as I mentioned before, earnings growth in America is very good, and the Fed is very supportive. So it's not so clear that investors are going to be moving significantly into emerging markets. Emerging market equities aren't necessarily much cheaper than developed market equities. So at this point, with a very solid U.S. recovery and strong earnings growth, if you look at the risk to the reward for investing, particularly in U.S. equities versus emerging market equities, we think investors will continue to allocate towards EM. We don't expect them to pull back, but at the same time, we're not expecting a big rush of new funds into emerging market assets.
Daniel, back home in India also, the earnings expectation for FY20 is somewhere about between 20 to 25%. The valuations also for Indian markets remain at elevated levels if you were to compare to other markets. So within that emerging market basket, what's the view about India? Also considering there are a lot of factors now in the near term which will weigh on the markets. We will be getting results of general elections on May 23rd.
Well, I think from a foreign investor point of view, and you've seen this after elections in other countries, of course, we had the Indonesian elections recently, Brazil elections a little while ago, is the balance between investor hopes for reforms and progress, how immediately or how quickly that's reflected in equity market valuations even before you've had any chance to implement the reforms, and then inevitably does there come a bit of disappointment and reality starting to set in at some point. So I think from an foreign investors' point of view, it's that balance. Expectations, of course, quite high after the initial election of Modi. At this point, if we look at the valuations, probably a little bit more cautious, and we'll want to see really, do we see the reforms that were promised before actually being implemented, and that ultimately, frankly, showing up in corporate profits.
All right, we'll leave it at that, Daniel. Great to hear from you. Thank you so very much for joining us this afternoon. All right, moving on to some earnings then, and Brigade Enterprises reported a really strong set of numbers in the fourth quarter of this year. Their profits jumped 3 times and the top line growth was 75%. Atul Goyal of Brigade Enterprises is joining us right now on the show to take us through how the quarter gone by has been. Mr. Goyal, thanks very much for taking out the time. While obviously there have been various other aspects that have aided the bottom line, including the likes of another income component, there has been a share of profits from associates which was up by about 3.5 times. In the base quarter, there was an added expense. But the key factor remaining that the top line and the revenue growth has been a strong 75%. How was that achieved?
Yeah, thanks. See, revenue top line has been good, and it is not in real estate segment. It has been good in hospitality as well as the leasing segment. Real estate sector has been, I think, doing well. It has been improving, and if you see overall inventory, unsold inventory has also come down in the market, and inventory overhang has also reduced from 46 to 15 months. So we are very hopeful, and we hope to continue this run rate in further quarters, in coming quarters also.
Could you give us any indication of what you're targeting for the upcoming year in terms of the amount you're looking to sell in terms of million square feet? I believe you've crossed your previous target of 2.8 million square feet already for the year. You're clocking 2.97 million square feet. Is there any incremental target that you're placing out for yourself for the upcoming year?
See, we are targeting around 30-35% growth in coming year in our residential sales, and we are launching around 5.5 million square feet of residential in next year, which will be a combination of affordable housing, mid-income housing, and a luxury housing, which we are going to do in our Chennai property, which is with GIC in WTC, near WTC Chennai.
Okay. Could you let us know how you're expecting the overall demand scenario, and in terms of pricing, whether or not there is a pressure for developers like yourself to bring down those prices, rather, some incremental discounts that you could probably look at giving out?
See, if you see in South India, the prices have not dropped so much, so it has been stable, and I think that stability in prices will go I don't expect much increase in prices. Prices may increase by 5% going ahead, which will be also mainly due to the GST rate, which is now 1 and 5%, where input credit is not available. So prices may go account, or for that matter, developers will increase the price to offset that extra GST cost. But overall, market has an absorption, and I think the growth which we are targeting, market should absorb.
We just did a discussion in the morning where there was a Knight Frank report that was put out that suggested that while some prices have been coming off, the demand in terms of the square foot area of residential properties has gone down as well. Are you seeing this segmental breakup there in terms of what kind of properties are moving faster and the inventory is going off at a faster pace?
Yeah. So, inventory which are going today is affordable housing and mid-income housing, which is in the target of, say, less than 1.2 crores. So that is going very fast. Luxury housing, yes, there has been slow. I have not seen the Knight Frank report, but I think they are combining all India reports. So you have a majority of luxury housing in Mumbai and NCR where the growth there has been degrowth in luxury housing. But mid-income housing and affordable housing is a area which has been growing very fast, and I think it should grow rapidly also in future.
Okay, let's talk about the leasing business, Mr. Goyal, and how is that done for the quarter? And going forward, any comments with regards to yields and the movement thereabout?
See, leasing business have done very, very well. I think our EBITDA margins have increased to 68% from 63% from the last quarter. And we are in our operational properties, we still continue with a high rate of leasing. And I think now, since two big properties of 5.5 million is coming in this year because of the SEZ sunset clause, which is till by 31st March 2019. So we are doing a aggressive leasing there, and we are getting very good response both for Tech Garden Bangalore and WTC Chennai. So I think our leasing will be very, very prominent in coming year, and we should have a target. We think that the run rate of leasing may be around 0.8 to 0.9 million per quarter, which we'll be doing.
Okay. One last question, Mr. Goyal, before we wrap up this interview. It's going to be on your debt, and I think it stands at closer to 3,000 odd crores. Any plans of bringing that down?
No, see, the debt will not go down because, we are into the capex phase right now, both in hospitality and leasing, and I still have around 14-15 crores of capex which has to be done. Out of which, of course, half of this will be the equity infusion both by us and the GIC, but around 750 to 800 crores infusion will be there in this leasing and hospitality, majority in the leasing, which will be a fruit from next year. So I think that is not going to come down, but from next year, all this leasing debt will also get converted into LRD, so which will be at lower rate and which should be more efficient for our balance sheet.
Yes, so servicing that debt will become easier. The quantum of the debt may not reduce.
Yeah.
Okay, Mr. Goyal, thank you very much for joining us. Really appreciate you taking out the time. As the management of Brigade Enterprises, a relatively good quarter for them. Top line has grown. There have been some added factors that have aided the bottom line, but the top line is a pure function of how much they sell. So a 75% increment of that, is really commendable. Though the stock, in line with what the rest of the real estate pack has been doing, started off strong, about 3.5% to 4% higher, dwindled off, and right now just about consolidating somewhere closer to 227. And that's the face of the entire real estate pack. Whether you take an Oberoi Real Estate, I think even Godrej Properties for that matter would be down. In Indiabulls Real Estate is down. Soba Developers is down. Okay, so Godrej Properties was down and now it's picked up, so closer to 1% for Godrej Properties, and Indiabulls Real Estate down about 5.5%.
Okay, the market continues to be weak. However, Nifty is very close to the mark of 11,400. Remember, we've already breached that, by the way, for the day. But on the downside, we will be watching out for the 50 DMA. But something like Cadila Healthcare, just pull up that stock. It's down almost 4% now in trade, and we've seen, yep, it's a day's low, 4% lower for this one. Also, idea we've already highlighted at the start of the show. And interestingly, CET, which came out with the numbers, though operationally CET's quarter was weak, but it looks like maybe on sequential basis the numbers were looking better. Also remember, the stock's down 20% on year-to-date basis. It was already trading with some bit of cuts, and maybe some bit of bounce has been coming in today's session. Okay, from Brigade, let's talk about some other earnings of National Fertilizer. If you go by the March quarter earnings, the revenues were up nearly 47%, and the profit growth was about 20%. We're joined by Mr. Manoj Mishra, who is the chairman and MD of the company, to decode their fourth quarter performance. Hi, Mr. Mishra. Good afternoon to you, and thanks a lot for joining us today on Bloomberg Quinn. Congratulations on good set of numbers. Interestingly, Mr. Mishra, the margins have surpassed the level of 7, and I've not seen that in the last few quarters. Tell us what aided the performance this time around on all parameters, operating performance, and even a good bottom line growth.
Yeah, good afternoon. Actually, not only this last quarter, the year as a whole, I will speak a year as a whole, it has been phenomenal in terms of production of urea. We have done exceptionally well, all-time high record of 38.59 lakh metric ton at 119% capacity utilization. Then sale at 48.95 lakh metric ton, and say that you can see the production and sale difference is all close to 1 million. So 1 million ton sale of our own urea fertilizers. So this, and along with the EBITDA and along with the profit before tax, all those are our best ever since inception. So now actually it has come through our sustained effort to push our, not only focus on our own urea, but also go for non-urea products. So in the last quarter, we made actually real effort in cornering maximum market share of non-urea. So that is the reason that this last quarter has been exceptionally well.
Mr. Mishra, I don't know if I missed out.
If I may add, this is in spite. Yeah, please. And I'm saying this is in spite of the fact that the last quarter also saw an increase in interest cost because of high subsidy recovered from Government of India remaining outstanding. Because of that, my interest burden has gone up. Our requirement of working capital had gone up. In spite of that, because of higher volume of business, our profits are higher.
Okay, and what's the outstanding subsidy as of now from Government of India?
As of 31st March, it was over 5,000 crore, over 5,000 crore subsidy, and I think 1 year back it was close to 3,000 crore. So you can see the impact on the profits and impact of the interest outgo on the company. So that was a real challenge, but because of much higher volume, you could actually withstand that, overcome that.
Okay, and any timeline, Mr. Mishra, as to when you can get the subsidy amount from the Government of India? Are there any conversations which have taken place with the government?
Actually, the subsidy is an ongoing process. The government has a fixed budget for fertilizer subsidy, and notwithstanding there being DBT in place now for all India rollout, of DBT has taken place. But if the fund is not available, the budget is exhausted, then definitely, naturally, the subsidy flow close down. It is actually slows down. So with the new year setting in, I'm sure that the subsidy flow will come. But unless and until there is an increase in budget provision for subsidy in the next year, this is a perennial problem, and the industry has been struggling for the last, I think, over a decade now. We have been struggling with this. At any given point of time, for the industry as a whole also, huge amount of subsidy remains outstanding.
Okay, fair enough. You mentioned that your finance cost went up because you've not recovered subsidy and you had to meet your working capital requirement. So will this scenario continue even in the quarters to come by? Can we expect the finance cost to be higher because you have to meet your working capital requirement in case if you don't recover the subsidy amount from the Government of India?
then generally it happens in the first quarter, second quarter, and probably the third quarter also. This flow of subsidy is better. So the situation definitely going to be better in the this current quarter as well as the next couple of quarters. But again, when the next March comes, unless there is a huge increase in the budget provision, or last year there was a special banking arrangement of 10,000 crore rupees. So that actually reduced our net budget. When I am saying 5,000 crore outstanding, it is a net of special banking arrangement amount whatever we received. So that is the thing. So next 2 quarters, we don't feel problem will be eased.
Okay, could you give us a sense on how the urea prices are currently and what's the outlook there? Also, what's the capacity utilization?
See, as far as urea is concerned, urea consumption after 2 years of stagnant growth, or in fact relatively negative growth, the urea consumption has bounced back, and probably this year urea consumption in the country had been 317 lakhs or so. So that was an increase of almost 5% in urea consumption. So that is a very good sign. And there has been massive availability of fertilizer all across, not only urea and other products also, DAP, NPK, MOP, huge stocks are available. So that is on the urea supply position side. As far as pricing is concerned, see, as far as urea is concerned, domestically it is price is regulated. So we continue to with that. The differential between our cost of production and the MRP at which we are allowed to sell, it is given to us through subsidy, which results into our subsidy receivable. So in urea, the prices actually doesn't matter. Yes, as far as the international prices of urea is concerned, so the system under which the policy regime under which we are working, it is like that beyond 100% of our reassessed capacity production, which is close to 6 lakh ton for NFL, that is regulated in terms of what is the international price of urea. So there the international prices comes down, our negative return becomes very meager. That is a source of concern. The urea prices coming down internationally, but of course for the country as a whole, that cannot be a better news than that. The urea prices internationally is coming down. But for company like indigenous companies, we are feeling a situation where the gas price, which constitutes almost 70 to 75% of the cost of production, it is going up. If I say the gas prices are over $12 per MMBTU, which is almost 25% higher than the prices which was prevailing a year back. Vis-a-vis that, the urea prices have actually come down. International prices of urea have come down. So there is a pressure on the margin available to the production units on the production beyond 100%.
Okay, so you're saying gas prices are going up, internationally urea prices are coming down. So can we expect your margins to be under pressure then in the current quarter?
Oh, no. Actually, this generally affects the last quarter, because this has to do with the production beyond 100% of capacity. No doubt we reckon it quarter to quarter, but definitely if the urea prices are low, international prices, and the gas prices are higher, so that portion of our production which is beyond 100% of capacity, there is a pressure on the margin, and it's across for all the companies. The same pressure is for us, because under the same policy regime everyone is working.
Okay, Mr. Mishra, we'll leave it at that note. Appreciate you joining us and taking us through your March quarter earnings, and all the best to you for FY20. Well, that's the management of National Fertilizer. The March quarter numbers definitely good. Margins of 7.7% is something we've not seen in the last few quarters. But the stock, however, has not done too much. Even on year-to-date basis, I believe it's down 2%. But the valuations seem to be on the lower side. I think on the trailing PE for this one is somewhere about 6 to 7 times compared it to its peers. I think the PE is somewhere about 12 to 13. Okay, let's bring in our technical experts. Index is at 11,408. We're joined by Manav Chopra of Indiabulls Ventures, and also joining us on the show is Ruchit Jain of Angel Broking. Good afternoon to both of you gentlemen, and thanks a lot for joining us. Ruchit, let me come to you first. At 11,400, would you take a fresh trade on the short side on Nifty?
Yeah, hi, very good afternoon everyone. Yesterday we have seen that the crucial support of 11,550 was breached in the index. Post that, we have seen a good follow-up selling move today also. If you look at some of the options data, and yesterday till afternoon 11,500 has the put option had the highest concentration, so which indicated that 11,500 was a support. But once that support of 11,550 500 was breached, we saw some good unwinding happening in 11,600 as well as 11,500 put options. And in fact, if we see today's trading session, then 11,600 call option now has attracted very highest open interest. In fact, even 11,500 have been witnessing writing at high levels. So this clearly indicates that the near-term momentum after breaching the support of 11,550 is still negative, and we believe that this negative momentum would continue towards its next support levels of 11,370. Which is the 38.2% retracement of the entire up move that we have seen since March, and even 11,310 could be tested, which is the 89 EMA on the daily chart. So as of now, trend remains negative, but if you ask whether a fresh trade should be taken over here, now if we see 11,550 was the support, and we are already about 150 points lower from those levels. So you won't find a good risk reward ratio or a good stop loss to go short at current levels. So we are advising our clients to stay light on positions at current levels. If any existing short positions are there, then they could continue to hold on for targets around 11,310.
Okay. Well, 11,310, that's the call that is coming in on the index. If that is indeed the index view, Ruchit, what about specific stocks?
Sell ideas on stock specific front as well. One of the idea that we have recommended is to go short on Cadila Healthcare. If we see, the stock has breached its previous support today and is now trading at 52-week low. The volumes on the sell-off are also good. This is an indication that the corrective mode could continue in short term. So at current levels, also keeping a stop loss about 300, one can go short for near-term target around 265.
Manav Chopra of Indiabulls with us as well. Manav, good afternoon, good having you. What's the index strategy that you have? We are already at about 11,400. Is the risk reward in favor of somebody going short right now?
Yes, it is. In fact, the markets, after a breakdown from its consolidation pattern, today we see the breakdown has accompanied by a falling gap. And Neeraj, such formation usually indicates that the momentum on the downside would continue. Keeping that note, after a long time, the momentum indicators have also given a negative crossover. So in short, I expect at least for next week or so, markets could remain choppy with a negative bias. You could see some more legs on the downside. On the immediate basis, one can maintain a stop loss close to 11,500 on the upside, and we expect lower targets of 11,250 to be achieved. So the risk reward ratio is still quite favorable. I sense at least a mean reversion towards 11,200 could be quite possible. On the medium term, long term perspective, the trend still remains bullish. So, keeping that note also in place, so 11,100 could be a sweet spot for any positional or a swing traders to get into the market. So at the moment, be very selective on long positions, but there would be some momentum at least on the short side.
What about specific stocks, Manav?
Yes, I have my first call, which is a sell on Sun Pharma. Basically, the stock, after a good sideways momentum, has seen a breakdown below both its long-term averages, and importantly, the breakdown has also accompanied by above average volumes. If you are looking also on the weekly charts, it's trading below its important weekly support zone. So I sense at least in the near term, the stock will continue to witness selling pressure. Overall, this has been an underperformer within the pharma space, and a stop loss of 450 for Sun Pharma on the upside for lower targets of 420. The other call would be a buy on PVR. Basically, the stock has been in a very good strong momentum, and we haven't seen any brief correction into the stock, which has actually been bought in the past instances. The stock has recently declined from a peak of 1820 and at the support near of 1750 levels. So a good risk reward strategy in such markets, and we've often seen PVR being a relative outperformer for Nifty in such scenarios. So keeping that into picture, 1730 would be a stop loss for PVR on the lower side, and for an upside target of 1825.
Okay, those are some stock ideas there, PVR being one, though Inox is the one that's was doing relatively well in trade today, ahead of their numbers. Inox is up about 1.5% right now, 308. What's not doing well is yet again Z, and we've spoken a whole lot about this stock and how the movement has been for this one. Volumes have been much higher than yesterday as well. So in yesterday's session, We had a number somewhere closer to about 17 or 18 or even 20 million. Today it's about 53 million in terms of the volume. For Z at 340, Manav, what would you do?
Actually, the stock has already seen a very sharp decline from its recent highs. It clearly indicates the formation. There has been a lot of aggressive selling positions or long unwinding which has taken place. I don't see any respite for this stock even going forward. So, only aggressive traders can look to initiate long positions, short positions, but it has to happen near the levels of 355, 365 near the resistance zone. And anyone who's still holding on to a short position, those lucky traders, I sense, on the lower side, this formation is likely to see further declines. Will not be surprised to see if the stock retest the lows of 300. So any short-term recovery should be actually looked into for initiating long position. Maintaining a positional stop loss of 360 on the upside for the shorts could be the ideal strategy for Z Entertainment.
I forgot the analyst who gave us a recommendation on
Adrian Mendonca.
I think it was a call yesterday morning where he said he would be going short.
Worked out well. Let's wait and watch what happens during the course of the next few days in Z Entertainment. Okay, the next story that we're tracking is Siemens. The shares are trading with declines after its parent Siemens AG approved the spin-off of its gas and power business into a separate entity. Why would that be the case? Darshan Mehta is here with the details. Darshan, what is the concern of the investors here?
Yeah, so basically, it's not the first time that Siemens has done this. There were a couple of times in the past also, when Siemens did some bit of restructuring in the Indian business also, and which did not go well with the minority shareholders. To just give you a perspective on what happened is that overnight, the parent company of Siemens decided to demerge the entire gas and power business of the company. That will be spun off into a separate unit and listed in 2020. And they're looking at gas and power, which is they're looking at the industrial business as a whole, which is a high margin business, rather than the power and gas business, which probably is a low margin business at this point of time. How does this affect the Indian business? First of all, it's a big business. So 45% of India's revenues will be impacted because of Phillip Capital, because sizable chunk comes in from the oil and gas business. Now, oil and gas by the power and gas division. Now, the power and gas division is part of the energy management segment, which accounts for 52% of the FY18 revenues and 56% of the FY18 EBIT. So it's a sizable chunk, and if this gets taken out, investors are worried. Now, Siemens India is saying that they are reviewing the impact and they will evaluate on the further course of action. And at this point of time, they are working on what they're doing. They don't have any clue because it's a decision taken by the parent. But really, the problem is if it's a mirror listing, there's no problem. But if you saw what they did earlier with the healthcare business, with the mining technology business earlier also, investors were given a bad deal because it was basically that was done something that aided the parent company, not the Indian minority shareholders. So that seems to be the worry. There's no clarity on how they will go about with it, but concerns still remain whether the minority shareholders will get a fair deal in this or no.
Still a decently tracked stock here, Siemens Limited. I think if we get, Darshan, thanks for that. We should get up the ANR of Siemens to see, what exactly could be the price target for the stock here in India. There is still a return potential of about 5.3 odd %. 40% of analysts recommending a buy on Siemens India, following 35% who say hold on to the counter. Very few sell calls, just about 5 sell calls coming in the counter.
Yeah, just before we get to Sanjiv, Bhasin, just want to mention Chennai Petro. The results came out. The stock is down about a couple of percentage points. They've slipped into a net loss versus a profit in the corresponding quarter last year. So just some bit of pullback there. But getting our fundamental voice on the show, Sanjiv Bhasin of IIFL with us on the show. Sanjiv, good having you. It's been a while. Thanks so much for taking the time out. How are you assessing the weakness in the markets currently? Overdone? And would we see a bounce? Are you telling that to your clients, or would you believe that the nervousness would stay and therefore best to sit on the sidelines?
We've come a long way from 10,500 to 11,850, and in the month of May, the general adage is sell in May and go away. Donald Trump has added to the volatility with his tweets, and a much needed correction in global equity markets which were running unfettered has put a roadblock. India is part of it, but now, the cause and effect, the talk when I heard 11,800 was that BJP is coming back with a majority, and at 11,400 now BJP is not coming with a majority. So aside from that, I think numbers on the broader market have been much better than expected if you leave aside consumption and some of the discretionaries. But I think the earnings are going to turn around. We think macros are in your favor in the shape of rupee, bond yields and inflation. So I see no reason for despondency if you have a slightly longer term view. This was a correction which was needed after a very, very strong rally. And we think that, we are looking at the next 6 months rather than the next 16 days, which could be volatile because of the elephant in the room being the election. Globally, I think equities as an outperformance will continue. You've seen gold, real estate and bonds do nothing. In fact, bond yields are at the lowest in the US 10-year yield also, which indicate cheap money is going to be there in abundance. But the volatility is definitely a little bit unsettling.
Hi Sanjiv, good afternoon to you. Let's chat then stock specific. We had SEAT coming out with the numbers. Of course, operationally it was expected to be a weak quarter. We've seen the stock on year-to-date basis, it has underperformed. But after the earnings, I think on sequential basis, there was some bit of improvement still. If you track this space, what did you make of the numbers and what would you advise now on SEAT?
Correct. So, SEAT has been a part of the OEM on the autos, which has been the arguably the worst performing sector in the last 2 quarters. And understandably so, after a 5-year run, we are aware that Ola and Uber and the problem of insurance and the NBFC fiasco has really hit the underbelly. But this is a long-term wealth creator. The prices are in your favor because the brands have become extremely more lucrative on the sell side. But like we are thinking that consumption after this election will undergo a sea change, given that capex both from the government side and on the private side can see a much needed shift. So commercial vehicles is where definitely we see an uptick. We also think the autos, particularly if you hear the commentary from some of the select players, they think the SUV market and others will be starting to improve maybe in the June quarter. So SEAT and Apollo Tyre would be good buys if you have a slightly longer view. But like I said, we want to play the OEM cycle more on select players. So Exide, Apollo Tyre and at this price, Motherson Sumi would fit the bill if you want to play slightly longer term on the autos.
The pure play autos, Sanjiv, I mean, the question marks around whether or not this pain is going to last for a few quarters more, whether it be passenger vehicles, whether it be trucks, all of them put together, two-wheelers. How would you read into this?
Yes, so we are aware, you've heard the numbers, you've seen the monthly sales. But there is a price point which is very effective, and I like to buy fear when underlying everyone is pessimistic. And I can see select autos because of the brand, the sheer value of the franchise doing extremely well, maybe a quarter or two down the line. So in that, if I could name three players, it would be Ashok Leyland, Eicher and Bajaj Auto in their respective plays. Ashok Leyland purely because it's gained market share in the LCV, MHV. Their new launch on the ICV, that's the intermediate commercial vehicle, has done exceedingly well. They are gaining more market share in the bus market. Their new launches in CIS countries is again going to be a icing on the cake. And the valuation from 170, the stock is at 85. So I think this is a very, very good level to enter Ashok Leyland. Eicher Motors purely on the back that Siddharth Lal has created a franchise which is pan-India, and the youth aspirations on motorcycle is an ever rising uptide, and I think that should see it in good times in the next few quarters. Bajaj Auto purely on the back that they sacrifice margins to gain market share, which has played out well, and now margins from the management seem to be back on track. Their subcontinent business is also going to be another adder in the next few months. So it would be these three names in that pecking order. If you are a value picker, then Maruti may have priced in the worst at 6,500. You could do a SIP or purely buy some mutual funds which are more auto-centric.
Okay, I think the markets are at fresh lows, at least for the day. Nifty is now 11,000, below that mark. And for both Bank Nifty and Nifty, we've reached that 50 DMA, which we were highlighting. Bank Nifty slipped below the mark of 29,000 now. So the selling pressure is only intensifying. Pull up the intraday chart of Rain Industries. A while back, the numbers had come. Profits were down 72%. Revenues were down 3%. The margins came in at 11. But after the numbers, the stock slipped into the red. But from that lower level, once again, there's some buying emerging for that counter, and currently is sitting with gains of nearly 5.5%. Manav, if I could come to you on the index now, what should be the strategy? We're at day's low, 11,380.
See, I just mentioned some time back, in spite of such kind of a downslide, the risk reward was still favorable for the bears, and we expect that the current scenario and the kind of the breadth the market has, I sense 11,200 could be the targets that one can look out for. So someone who has taken the trade, possibly can also maintain a trail stop loss near the day's high. So, it acts as a more or less like a protective stop loss. But looking at the current scenario, I sense we could see a negative weekly closing for this week, which could also be quite bearish for the markets, at least for the near term. So one should maintain positions mainly on the short side going forward.
Okay, got that. The markets continue to slide at this point. But remember, our conversations earlier on in the day with Gautam Shah of GM Financial suggested that, he's of the opinion that around these levels of about 11,400 odd is the time that he'll start looking to buy into the markets. Z continues to grind lower and now sub 340. That's 339 right now. Not at the intraday low. It had gone lower than this. But still a heavy cut of about 8.5%. Sanjiv, Bhasin, what will you do with the Reliance Industries now that breaks 1,300? It's just about very close to, nudging 1,300 on the downside. Last 3 or 4 trading sessions have not been particularly kind for Reliance Industries, and being the heavyweight that it is on the index, it's pulling the index lower with itself.
Well, there has been 3-4 days of basket selling by select foreign institutions, and I think ICICI, HDFC Bank and Reliance have been the stocks which have seen maximum unwinding. I think Reliance now at these prices is fairly priced at least for a 10% upside by the year end. So if you have been waiting to buy Reliance, we still think 1,550 to 1,600 by the end of this year should be on the cards. It has been a bellwether in the shape that Jio has garnered market share, and their GRMs, which were lower, we think could start to see an uptick given that they were 10 days lost because of inventory regulation and closure of the plant. I think Reliance now at these prices seems very fine. And like I said, I think this 11,350, 400 is a zone where I don't see the market going lower. If it does, it could be momentarily. We think these are very, very good opportune times. And, Devina, the broader market is looking extremely lucrative given that it has been underperforming, and we think that once we are past the elections, the second half could actually belong to the broader market. So be selective, try and look out for some of the select themes. We'll name a few themes which we are extremely bullish given the results and given the macros. So we would play those themes and stocks related to them.
Vodafone Idea, now that we've seen post rights issue, the shares hitting the market, what would you do at a price point of about 14.5? Manav, Chopra?
Actually, the prices have been in a, it's been in a downtrend. We have often seen recently any bounce back into the stock has actually been sold into at higher levels. I think this trend will continue going forward. The overall momentum for the stock has been very weak, so I've not seen any follow-up buying coming into the stock. In fact, it has been trading below its 20 DMA since past 6 odd months. So it clearly indicates that this is a stock where one should not initiate any long positions, and I strongly recommend one should not go for any sort of a bottom fishing into stock like Idea. So it's completely an avoid at the current levels, and in case if there is also a bounce, ideally one should look to exit, but don't enter into long positions into this.
Okay, pull up the chart of Z. I think the stock's fallen once again. It did recover from the day's low, but I think it's seeing more selling pressure at higher levels, down 8% in trade. Sanjiv, before we thank you, any views on this counter? Management has given clarification that they are at advanced stages with regard to stake sale, but a lot of rumors also in the market. But if somebody is holding the stock in the portfolio, a lot of the experts are saying that fundamentally nothing's wrong with the company, but it is the stake sale, I guess, which is in focus. What should one do? The stock's now around the levels of 330.
Very painful question, and this is telling you that these errant promoters have actually been the real bane of Indian corporates, and whether it's ADAG or Yes Bank or select over leveraged players, Z has been taken the cake. And I think that till I don't see money on the table, I'd rather not buy it. I'd buy it more expensive, but let the value be created. I would rather shift into a Sun TV, which I see gaining market share because of the regional languages and some of the effects of this election verdict, which could play out very well for media ARPUs. On the other hand, if you do want to play media, then some of the data producers, particularly Reliance and Bharti, they would offer a better entry point. Z for me would be an avoid.
Okay. Sanjiv, we'll leave it at that. Thank you so very much for joining us this afternoon with your thoughts. That's Sanjiv Bhasin there with his opinion on the markets. Time now to take a very short break, but before we do that, Jyothy Laboratories has posted a mixed quarter in line with subdued performance of several peers in the FMCG space. To know more about the extent to which the slowdown has an impact on the earnings, Agam Vakil had a chat with the Joint Managing Director, Mr. Ullas Kamath. Listen into that conversation.
In fact, the current quarter, but for household insecticides, we have done fairly well. It's about 9.3% top line growth, and the healthy EBITDA margins, what we have got for the current quarter is 16.4. And overall, if you see the market sentiments in the rural India is not as good as what we expected. However, the smaller SKUs are doing very well for us at the marketplace, especially in rural India. So with that, we are able to deliver whatever the numbers, like more or less both on the top line and EBITDA margin. However, it could have been much better if household insecticides has taken off, and also if the rural has taken off. Generally it takes off in our case 1 to 1.4 times when compared to urban. If it had done, then probably will have gone up to 11 or 12% top line growth.
Okay, all right, sir. So since you have mentioned a little bit of a slowdown in rural growth, and that is the case in case of a lot of your peers too, what is your reading on ground, and is there any point at which you can expect some recovery when it comes to rural growth?
In fact, rural growth, in my experience of decades being in this business, it is always dependent on three things. One is on the rain, the second one is on agricultural produce and the recovery price for that, and the third one is the government spend on social sector. And in the current year, some of it were not in time, and even though the direct transfer happened, to what extent has gone to the extent of the consumers where we are supplying the products, we are seeing the traction now. But overall in the current year, we had a mixed trend coming from the various states. Some states have done very well in rural India, some states have not done that well, and some of where rainfall has not been good, they didn't have much money to buy like FMCG product. Having said that, in the current year, I'm very hopeful that now that monsoon is going to be almost normal, and direct transfers of the government is happening very effectively, and also the government spending on the social sector and creation of some jobs should help us to go back to double-digit growth in the rural sector as well.
Mr. Kamath, we are also seeing a little bit of pressure when it comes to gross margins. What are your observations when it comes to input costs now at this point in time?
In fact, input cost is not a worry for us because post GST, most of the benefits will go to the consumer. At the same time, any input cost will be passed on to the consumer. And at Jyothy, we don't have any worries on input cost as such because it always be passed on. In the current quarter, if you see about 200 bips reduction in the gross margin, is mainly because of the consumer offers. We ran with a 2+1 offer, 40% extra, 20% extra. All of them have gone as a cost of goods sold. To that extent, the sales promotion has gone through our cost of goods sold. That's why you see that 200 bips reduction in the gross margin. Otherwise, we are a healthy gross margin at about 48%, and we'll continue to maintain that 48-49% in the years to come also. but no pressure on input cost at this point in time for Jyothy.
Fair enough, sir. So your biggest segment, that's fabric care. Again, we're seeing a near 4% growth here as well in terms of segments. What's the outlook that you can provide us with, considering this one is a critical one when it comes to growth?
For us, the real growth driver is the dishwash segment, which is about 32% of our business, and both Pril and EXO, the two brand strategy, is doing very well for us. We are number 2 now in the country in the dishwash segment, and also if you see the last 5 years, our CAGR has been upward of 20% in the case of EXO and Pril. So that's our star performer, healthy EBITDA numbers there, and growth has also been very good, and we're garnering the market share. Coming back to fabric care, and fabric care, Ujala has been a dominant player as always, upward of 80% market share, a healthy gross margin of upward of 70%. That's doing well. But whereas the other fabric care detergents in the last quarter or maybe about 5 months, most of us, we are running a huge consumer offer up to 2+1 in matic version, and 30%, 40% extra weightage in the regular detergent powder. To that extent, the volumes have gone up. Value wise, you see a little depression, but the 4% growth overall in fabric care should be about 8-9% in the coming quarters.
Okay, and a final question, sir. So you did allude to the household insecticides briefly, and we've seen some weakness in case of your peers too. My question is, to what extent does the weakness have to do with seasonality, considering we did see a delay of the summer onset and also a prolonged winter? Does seasonality have anything to do with the demand here?
Yeah, in fact, it's only the seasonality which used to affect us in the past. Like if the rainfall is on the right time and winter sets in quickly, and delayed summer, all these things will have been a positive trend. However, for household insecticides, the mosquitoes, they're the only thing, and it used to be a positive trend in the past, and only negative will have been the seasonality. Having said that, a couple of quarters we have seen spurious material, which is unethical chemical composition agarbattis had come as a proxy to mosquito coil, and that has become now almost 550-600 crore of a business, which was growing in the last 3 years, but now it has come to a standstill, and I see degrowth in that category as such. To that extent, it's good news for organized players in HI business, and hopefully that business should come to us because all of us have launched our own 100% natural variant in household insecticides in the form of incense sticks, and that business which is readily available, we should be able to get that business over a period of time. To that extent, there is no worries, but for us 12 to 13% of our business comes from household insecticides, so well protected.